Today I would like to share with you the 3 real situations where people lost anywhere from $20,000 to over $200,000 a year. Just a small disclaimer that this is for the educational purposes only. This material is strictly for education. If you do have some kind of a situation that you're working on, I would suggest for you to consult your tax advisors before you make any kind of decisions. And obviously, the wrong implementation can equal high taxes, potentially even some penalties, which you definitely do not want to run into. So here's the real problem that I see with all the taxpayers and business owners. It's different income, different industries, but the same situation. No strategy in the place. And this is what I want to share with you, that how strategy is very, very important. It's very vital. So this is case study number 1. It seems like it's very simple, but I do like to share this. Unfortunately, this is not very rare that I do see this. So this particular tax return that we were reviewing is this particular person. His income is only $12,000. So this is on a different side. We're not talking about even high earners. So I just want to point out certain things when the income is very low, or if you're not reporting the whole income and you're reporting on the lower level, what are the tax consequences? So in this particular case, this person reported $12,000 in income. And what he goes and does, he purchases a vehicle with cash for $24,000. So here's I'm even showing you the receipt. This is all real. This is the receipt that he purchased the vehicle, that the dealership sent him this. It was in September of last year. So with cash, $23,000. So for some of you maybe know, some of you don't. This is very important. What you would like to know is anytime you have a cash transaction of $10,000 or more, it gets to be reported to the IRS. So what does it mean for you as the taxpayer or individual? So in this particular case, he purchased this vehicle he gave them $23,000 in cash. So what the dealership does is the dealership fills out the form 8300 and sends it to the IRS. What happens in this case? In this case, then there's all these types of questions. Okay, where did you come up with the cash? Why, because again, like he purchased with the cash. Okay, if you purchased with the cash, you went to the bank and you had all this money on the bank account, you withdrew them. Okay, it's all good and it's all great. But now that the IRS received this form 8300 from this dealership, so now it triggers this research and search for them to see, okay, so if the money was legit, and then obviously the next thing what they do is the IRS looks at the tax return. So if you're thinking that, you're smart, no, the IRS doesn't know anything, that's not true. IRS knows absolutely everything. And this is how they match the information, whatever the dealership sends them, whatever transactions that you're doing with the bank, and then with whatever you're filing on the tax return. So this is the tax return that this particular person filed. So, and here's the problem. He shows only that he earned $12,000 a year. But then yet he takes $24,000 and he buys the vehicle with this money. So that's a potential trigger, which obviously I don't think anyone wants to, because now the question is, the IRS is going to question, okay, where did you have the $24,000 if your only income is $12,000? So then the lifestyle that you're living, it doesn't align with what you're actually spending. So believe it or not, very common. I see a lot of that. So that's why I wanted to share this with you. Also see a lot of those businesses that work with it's whether they're receiving cash or whether they're paying employees in cash. So it's not only if you're buying a vehicle or buying something with cash, it's also if you're withdrawing cash from the bank account or you're depositing cash to the bank account. So it works both ways as well. A lot of people, they're thinking, okay, you know what, I'm going to be smart. If it's 10,000 gets to be reported, then I'm just going to go and then deposit 9,900 in cash, or I'm going to withdraw 9,900 in cash. So here's the thing. Again, everything everything has to make sense. It's do you have the money? You withdrawing from your personal account or from your business account? Like, what are you doing with this money? Also, if you do this, let's say if you're depositing this cash on a weekly basis, I see this from the bank statements of the business owners as well. They would go like every other day or maybe every week and deposit the small amounts of cash to the bank. So here's what happens: that the bank, they have this whole internal investigation departments, and they actually monitor all of these transactions, anything that has to do with the cash in and cash out. So the same thing works with those that paying the workers with cash. Business owners, they go and then they withdraw every week, every other day, small amounts of cash. So you need to be careful with that as well. In this particular case that I'm sharing is that the IRS sees that the income is only $12,000, but then he's purchasing the vehicle for $24,000. Okay, so where did the money come from? So, and then this actually triggers in audit, it triggers potential penalty, and the third thing is potential higher tax liability. Which I don't think that any of you wants a knock from the IRS and then have an audit, and definitely do not want to have paying more taxes or penalties. So that's why just wanted to share this. Like I said, I do see this a lot happening with the business owners. So keep in mind that everything is monitored by the IRS and then the bank as well. All right, so the second case study that I wanted to share with you is this particular health professional making over $300,000 in income in 2025. Again, real case study will show even the tax return, and there's a lot that you can see, and I will point this out for you. So this particular person, so she's single individual, so she is in the highest tax bracket, which is the federal tax bracket is 37%. That's the highest rate that you're paying in taxes. And then also living in New York State, New York City, there's both taxes, so that's probably like another 10%. So we're talking about like 47% in taxes. So now here's simple things that I'm gonna point out to you. So even though even for the we're not even talking into any of the business deductions or anything, just a simple strategy. The simple strategy is with the pension. Absolutely love that. I think it's most underutilized, and here's why. I'll show you why I absolutely love this. So in her particular case, what she did is that she made a contribution of $14,000 in 2025, and then not only she made $14,000 only, even though she was allowed to do $23,500 plus an additional $7,000 because she's over 50. She also made this contribution as a Roth 401k. So for those of you that don't know the difference between Roth 401k and regular 401k, is that with the Roth 401k, you're paying the tax today, but then you're not paying later on whatever you make on the profits. With the traditional 401k, it becomes tax deductible today, meaning that in her case, if she would put away this $30,500, then she would save almost $15,000 in taxes. So you hear a lot. There's a lot. You hear that the other advisors say, other accountants, CPAs saying, Google, ChatGPT, your friend, your neighbor, your relative, and then you're listening all these different people. But the thing is that very important to understand is that there is no one size fits all. There's no strategy the same. There's no things the same. Is if your friend is doing this, it doesn't mean that it's good for you. If the CPA says that in a master class or anyway, it doesn't mean that this will apply to you, because every strategy, every situation is different. It all depends on your personal situation, on what age are you today, what lifestyle are you in today, how much you're making. So there's a lot of factors that will play into this place. So in her particular case, I suggest that it's putting towards the regular traditional 401k, not Roth 401k, because the $15,000 has more value today versus she's already over 50 years old versus what it's going to be in 10, 15 years. So, with the $15,000 that you can actually take today, invest and reinvest and do something versus actually giving them to Uncle Sam, knowing that eventually you're not going to pay any taxes on that, which is, you don't know that. So, and again, I love both strategies. I do love Roth strategy. I actually utilize this personally in my family, but then again, it all depends on the individual situation. Like, for example, my kids, for them, I contribute Roth 401k strategy. Why? Because they're in a very low tax bracket. So that would be one reason. Number two is because they're very young, so they have a lot of time to accumulate all this wealth. And obviously, they're going to have enough time to make more money and eventually not pay any taxes on them. For myself personally, I'm over 50. So I actually do the 401k, SEP, defined benefit plan, all of these plans as the deduction today, because I don't have already that much time to accumulate all this wealth. So for me, it's very important to take advantage of this cash situation today. So that's how I look at the strategies. If you would like to learn actually more about the differences between these, there's different types of pension plans. For those of you that my clients, you already know that. But anyway, if you would like to learn more, I do have if you don't know, I have a YouTube channel. It's absolutely for free. I have a lot of videos on the pension, different types of pension vehicles as well. So you can subscribe not to miss any videos. I do release them every week and every day, short reels. So anyway, let's go into the particular this person case study. So now. Here's her tax return, and I want to point out to you, there's a lot of things that I wanted to point out here. So first, as I already mentioned, if she would have actually, instead of doing this Roth, put everything into the traditional 401k, she would already save about $15,000 in taxes today. And as you see on her tax return, $7,729 just on federal tax now that she has to pay extra. You see, she has to actually pull the money out of her account to give it to Uncle Sam versus taking it from Uncle Sam. So that's number one. Number two, also, if you look at her tax return, and I see a lot of this in tax returns, if you look that she had the taxable interest that she earned from the bank. It's not like she didn't have any money. She did have the money. So she had an interest that she earned from the bank, which was over $6,000. Then also she had dividends over $8,000. And then also she had the capital gain. So now if we add all of this together, so we're talking about $20,000 extra in taxable income that now she has to pay taxes, right? So $20,000, and again, being in that 47% tax bracket, so we're talking about another extra $10,000 now she has to pay on the money that she earned here. So you see the $15,000 that we spoke that already she could have saved from this pension, plus this $10K. So we're talking about $25,000 that she lost to Uncle Sam versus actually having them in her own pocket. Why also I love this 401k strategy, as we already mentioned, besides this $15,000 that I shared with you, she potentially could have as an extra cash. Also, by putting this money towards the pension, she shelters them not to pay any taxes on them today. So look at it this way. It's like looking as if you have two pockets. You have a left pocket and you have a right pocket. So in the left pocket, you have your personal account, just like she has here, right? This is where she invested all this money and she earned this $20,000 in interest and the dividends and capital gains. So this is in her left pocket. Now, if she would have actually take this money and put them in the right pocket and shelter them under this pension fund, then everything that she earned in this right pocket, in that case, let's say if this would have been this $20,000, but it would have been under the retirement, then she wouldn't pay this this would be the retirement, she wouldn't be paying this $10,000 extra in taxes, because whatever you earn in this retirement account, it stays in that account and then gets to be deferred for the later years until you start taking the money out. So you see, like this, just this simple strategy, we're actually already talking, one strategy that turned out into this two different strategies where you can save and preserve this money. So I wanted to actually point this out too, because not many taxpayers, individuals looking at this, but it does cost you money. And here's another thing that I also wanted to point out, because this particular case, the dividends and the capital gains, they came from the mutual funds. And I see this over and over with the individuals that invest money. You put them in the mutual funds. First of all, you cannot even use this money. I mean, you can use it. Don't get me wrong. You can use it by selling this. But majority of the people, they just put the money there and then forget about them. So now here's what happens. You're earning these dividends, you're earning these capital gains, but you're not physically taking the money out. It's the reason you're earning these dividends and capital gains is because they buy these mutual funds, they go into the fund and they sell the fund, and this is where you have like realized capital gains, but you're not physically taking the money out, so like they just getting reinvested into the fund. So here's what happens now. Like this year, right, we were doing very well. The market was doing very well. So this is why she has like over $20,000 between the interest, dividends, and capital gains. So let's assume this year is perfect, right? You're paying $10,000 in taxes. You didn't even take the money out. It went back to be reinvested. Now next year happened, and now the market went down. You're losing the money, but what happens is now you pay $10,000 actually already. You're not getting them back. That's it. They gone. Uncle Sam took advantage of them. But now you don't even have the money because the market went down, the fund went down, and you're not even making any money right now. But the taxes are already gone. So this is another reason when you're sheltering them in your pension fund, whatever you make, whatever you lose, it gets to be offset. It doesn't matter for you at this point because you're not paying any taxes on that. So that's another point that I wanted to point out because this is, guys, like where you're losing all this money, your hard-earned money, by not utilizing these right strategies. So this third case is this doctor. He is a surgeon. He reported $800,000 in income, and family, husband, wife is helping him in the business, and they have two kids. One of them is in college. So what was actually wrong with this specific tax return with this client that specifically came to us is that there was no income structuring. There was no pension plan again, and no family strategy. Like all this $800,000 that were earned in the business, they were just all reported and paid tax on. And the taxes, it's a lot of money. So like that particular client over this past years lost so many money. And there is a lot of things that could have been done differently. Again, the income structuring, the pension contribution, using the family, paying the family members, taking advantage of the accountable plan. For those of you who don't know what is accountable plan, is if when you reimburse your employees for the expenses on the behalf of the business. So in that case, let's say if your spouse, if your kids become employees of the company, so then you can reimburse them for all the expenses, and potentially, like in that particular case, one of the daughters, she was attending the college, so the college could have been, and this is a massive cost, could have been deducted as well. So, and then because of all these lost opportunities, they could have actually shelter and deduct $600,000 in the tax deductions that potentially could have saved them over $200,000 per year in just taxes that unfortunately they paid to the government. Again, just wanted to point out like how just by structuring these three things, how the things could have been done differently. As I mentioned, after reviewing all these tax returns, just the big realization is that the tax system is designed to be, it's not designed to be fair if you do not know how to play this game. Because at the end of the day, this whole tax, it's a tax game. But then when you're playing the game, you need to know the rules. And if you know the rules, and this is when you can win the game. And one of the rules is to have the strategy, because the system is designed that way is for you to take advantage of it. But for you to take advantage of it, you gotta know the rules, and it's designed for the business owners, for the investors, for those who know how to play the game, how to utilize the strategies to take advantage of them. So that's another reason why I'm doing this every week with you, so then you can be educated, you can know the rules, and take advantage of all these rules by playing this game and get rewarded for it. Also, for those of you that new here, I am hosting another masterclass next week at 5 o'clock on Thursday. And by the way, for those of you that already attended, I would still advise you to attend, because every time there, I always give different case studies, different examples, different questions people ask. So it's always different. So definitely would suggest for you to attend. It will help you to identify, not just to file, because a lot of what I see is that the business owners, individuals, they're just focusing on filing the tax return. But then again, if you're focusing just on doing the tax return, then you're not playing the game. And that's why you're losing this game, because you do not know, you cannot identify these money leaks, implement the strategies, and build long-term wealth in the system with some of the strategies that I already shared with you here.